Welcome to a new deep dive. I'm genuinely excited about today's topic, Medtronic Pilot. This company is, well, it's a titan in the medical technology world, and diving into the rich source material you've shared with us, this comprehensive business analysis, it's been incredibly illuminating.
It's a fascinating.
Our mission today, for you listening, is to really understand what makes Medtronic an enduring business. You know, what are its fundamental strengths, maybe some surprising weaknesses, and what's really driving its future.
Right.
We want you to walk away feeling truly well-informed, ready to understand the nuanced story of this fascinating company.
What's compelling here, I think, is that we're looking at a company that directly touches human life in profound ways. You know, pacemakers, insulin pumps.
Absolutely.
But it also operates as a complex global financial entity. So we'll be connecting the dots between that core mission and its financial realities. Let's dig in and see what stands out.
All right, let's start by dissecting its business model. Medtronic designs, manufactures, sells a massive range of medical devices, therapies, addresses over 70 chronic health conditions. It's remarkably diversified.
It really is.
Can you walk us through its four main segments? Maybe start with the biggest one?
Yeah, absolutely. And that diversity, it's a cornerstone of their resilience.
Okay.
So their cardiovascular segment, it isn't just the largest, it's really their profitability engine. Brings in about 37% of FY23 revenue, nearly 40% of operating profit.
Wow.
Think of it as the bedrock. It funds, a lot of their cutting-edge innovations, everything from life-sustaining pacemakers, implantable defibrillators, to heart valves, stents.
Got it, the core.
Then you have Neuroscience, second largest, pulling in 29% of FY23 revenue, 32% of operating profit. This focuses on crucial areas like spinal implants, deep brain stimulation systems, surgical navigation, pretty important stuff.
Definitely.
Medical surgical, that was formed largely from the massive Covidian acquisition. Remember that?
I do, yeah. Huge deal.
That accounts for 27% of FY23 revenue. Offers advanced surgical instruments like staplers, patient monitoring systems.
Okay.
And finally, diabetes. Historically the smallest, with 7% of FY23 revenue and only 3% of operating profit. Known for its insulin pumps and continuous glucose monitoring CGM systems.
So it sounds like it's more than just, a one-time device sale. There's a stable, ongoing revenue stream in there too, right?
Precisely. Yeah, they generate a consistent income through long-term service contracts.
Oh, okay.
And these aren't just for maintenance. They include clinical support, comprehensive training for healthcare institutions.
So it really embeds them.
Exactly. This model essentially embeds Medtronic deeper into their customers' operations.
That's smart. What makes this business model so incredibly durable? What are the huge underlying trends that Medtronic is essentially riding?
Well, the core mission itself is timeless, right? To alleviate pain, restore health, and extend life.
Hard to argue with that.
It addresses a fundamental human need. But beyond that, there are powerful structural tailwinds, things that are set to persist for decades.
Like what?
First, the aging global population. That naturally drives an increasing demand for chronic disease treatments, which is their absolute specialty.
Makes sense.
Second, healthcare expenditure. It just keeps growing as a share of economic output. Look at the U.S., their biggest market. It's projected to expand from, 17.9% of GDP in 2017 to over 20% by 2033.
That's a huge chunk of the economy.
It's a continuously expanding pie they're operating within. And finally, the development of healthcare infrastructure and rising incomes in emerging markets. That offers huge runways for geographic expansion.
Right, new markets opening up?
Exactly. So even if specific technologies change, the human conditions they treat, they're constant, and the demand is only growing.
That makes perfect sense. So it's not just selling a product, it's addressing an undeniable growing global need. Can you give us a snapshot of their recent scale based on those FY 2025 figures from our sources?
Sure. Looking at the projections for FY 2025, their cardiovascular segment, expected to bring in about $12.5 billion in revenue.
Okay.
Neuroscience, nearly $9.9 billion. Medical surgical, $8.5 billion. And diabetes, about $2.8 billion.
So total.
The total projected revenue for the company is a massive $33.5 billion, roughly.
Wow.
These numbers truly reinforce their sheer scale and that broad diversification we talked about.
Impressive. So, with a business model that clear and robust, what exactly is its competitive stronghold? Its economic moat that protects Medtronic from rivals.
Right, the moat. Medtronic is essentially defended by two powerful moats, intangible assets and high switching costs.
Okay, break those down. Intangible assets.
Think of their massive intellectual property portfolio, over 49,000 patents globally.
49,000?
Yeah, that creates huge legal barriers for any aspiring competitors. Plus, the Medtronic brand itself. It's globally trusted, built over 7 decades of delivering life-saving products.
That trust factor is huge in healthcare.
Absolutely critical. But the high switching costs, this is where it gets really compelling for customers.
Oh, so?
Well, for surgeons, they invest thousands of hours training on Medtronic's specific device ecosystem.
Right. They get used to certain tools.
Exactly. And they rely heavily on Medtronic's clinical specialists and sales reps for crucial on-site support during procedures.
Ah, okay.
So for them, switching isn't just choosing a different brand. It's an incredibly costly and time-consuming retraining process. They'd resist that.
I can imagine. And for hospitals?
For hospitals, Medtronic often acts more like a strategic partner, not just a vendor, especially through its integrated health solutions.
What does that mean, practically?
They actually help manage entire hospital departments like catheterization labs or operating rooms. They help optimize workflows, manage inventory.
Whoa.
Yeah. So unwinding such a deep operational partnership is far more disruptive than simply changing a supplier for, say, gloves or something.
So it's not just a product they're selling, it's an entire ecosystem, almost like a digital fortress where every piece is interconnected.
That's a great way to put it. Imagine a hospital's neurosurgery department using Medtronic's spinal implants, its Maser robotic surgery system, and its stealth station navigation.
Okay.
The surgeons aren't just familiar, they are deeply experienced with this specific integrated ecosystem. Then the hospital has a managed services contract with Medtronic for optimization.
Right.
So a competitor can't just walk in and offer a slightly cheaper screw.
No way.
They need to convince the entire surgical team to retrain and the hospital to break a deep, operational, often multi-year contract. That's a truly formidable barrier.
That's incredibly sticky. How stable is this moat, do you think? Is it actually widening over time, or is it facing pressures that might be narrowing it?
It's a bit of both, actually, which makes it interesting.
Okay.
It's widening in some ways through their strategic pivot to value-based healthcare and these integrated service models. That embeds Medtronic even deeper into customer workflows.
Makes sense. However, it's definitely narrowing in other areas due to intense competition. Rivals like Boston Scientific, Abbott, Johnson & Johnson, they're always pushing.
Which limits pricing power.
Exactly. It limits their pricing power. Also, in emerging areas like surgical robotics, Medtronic is actually the challenger to Intuitive Surgical's very strong established ecosystem.
Right, Da Vinci.
Yeah. And, the decision to spin off the diabetes business that implicitly acknowledges that its competitive edge, its moat, had narrowed against agile innovators like Dexcom.
That tension between widening through services and narrowing due to competition is fascinating. Which force do you think is more dominant right now? And what are the implications for their long-term pricing power?
That's the million-dollar question, isn't it? It feels like a constant push and pull.
Yeah, and yet here's a puzzling contradiction I found in our sources. Despite these strong competitive advantages, Medtronic's return on invested capital, ROIC, it's consistently mediocre, often around 6-7%. Why is that?
That's a critical question to consider. And it is a bit puzzling.
Right. While their moat is very effective at defending market share, it hasn't translated into supernormal profits. This is likely due to two main factors.
Okay.
First, a capital base that's kind of bloated by the enormous goodwill from that $42.9 billion Covidian acquisition.
Ah, the accounting effect.
Right. Essentially, the premium they paid over Covidian's tangible assets sits on their balance sheet, and it weighs down those return metrics.
Got it. And the second factor?
The significant negotiating power of large hospital systems and government payers. They simply constrain pricing across the industry. Medtronic isn't immune to that.
Okay, so powerful customers keep prices in check. That low ROIC is certainly a key point given their strong moats. It makes you wonder, are these financial realities reflected in how people experience Medtronic? What's the real word on the street from customers and employees?
It's really a tale of two different businesses, particularly when we look at the diabetes division.
Okay.
The diabetes dilemma is quite stark. Public reviews, online forums, they're often filled with negative feedback. Like faulty sensors, frustrating customer service experiences, high prices. Many users explicitly express a desire to switch, feeling somewhat trapped or locked in.
Oof, that's tough.
But in a really stark contrast, testimonials for their newest products, especially the Mini-Meat 780G automated insulin delivery system, overwhelmingly positive.
Really?
Yeah. Users praise its life-changing impact, the reduced mental burden, its accuracy. It highlights the power of their innovation engine, definitely.
Right.
But it also clearly reveals a significant weakness in their customer-facing support for maybe slightly older, established products. It's a disconnect.
So on one hand, frustration, on the other, life-changing innovation. What about the employee perspective? Is that mission still pulling them forward, or are corporate realities weighing them down?
The Medtronic mission to alleviate pain, restore health, and extend life is undoubtedly a powerful unifying force. Our sources note that 89% of employees feel their work has special meaning.
That's high.
It is, and it's recognized as a great place to work, so that's a huge positive.
But there's a however.
There is. This positive sentiment is tempered by a palpable anxiety. Employees frequently mention annual layoffs or reductions in force, RIFs,
Okay.
which are often perceived, rightly or wrongly, as a tool to meet short-term quarterly targets, rather than a true strategic necessity.
Ah, making the numbers.
Right. Some feel the company has become too focused on cost-cutting over the kind of long-term innovation that really defined its past. This tension between a noble mission and these financially driven layoffs,
Yeah.
it's a tangible long-term risk, I think, to their ability to deliver those breakthrough innovations.
That's a really critical insight, that tension between mission and financial targets. Let's shift our focus to the leadership then. Jeff Martha became chairman and CEO in April 2020. What's his philosophy? How is he approaching capital allocation?
Right, Martha. He's a longtime insider, joined back in 2011, was central to that Covidian acquisition. He's pushing for what he calls a new Medtronic.
Yeah.
That's more nimble and competitive. His philosophy seems to revolve around three core themes. First, innovation-driven growth, investing heavily in high-growth medtech markets like pulse field ablation, PFA, and surgical robotics, things with big potential.
Got it.
Second, operational rigor, aiming to improve efficiency, drive margin expansion, tightening the belt where needed.
Standard playbook.
And third, decisive capital allocation, which involves actively managing the portfolio like the diabetes spinoff decision and returning a majority of free cash flow to shareholders.
How does that philosophy translate into tangible actions? What have they actually been doing?
Well, his actions certainly suggest a long-term, owner-oriented mindset. They consistently make substantial investments in R&D.
How much?
Between, say, $2.5 billion and $2.8 billion annually.
Yeah.
That's 8-9% of revenue, which is significant in this space. FY22 saw their largest single-year boost ever.
Okay, serious R&D spend.
Yeah. And acquisitions are also deeply ingrained in their strategy. From huge deals like Covidian down to smaller, focused tuck-in deals for new technologies, like acquiring Affera for PFA technology.
Yeah.
And when it comes to returning money to shareholders, what's their stance there?
That's a top priority, clearly. The dividend is practically sacrosanct. Medtronic is a dividend aristocrat.
Meaning they've raised it consistently.
For 47 consecutive years, they're committed to returning at least 50% of free cash flow to shareholders via that dividend.
And buybacks.
They use share buybacks, too, opportunistically, it seems, like $2.7 billion in FY25, over $2.5 billion in FY22.
So a balanced approach.
Looking at FY 2025, the breakdown was roughly $2.7 billion to R&D, about $1 billion for acquisitions, nearly $3.6 billion in dividends paid, and $2.7 billion in share repurchases, totaling over $6.3 billion returned to shareholders in dividends and buybacks alone.
That's substantial. What's the clearest evidence you see of this rational, shareholder-friendly approach from management?
For me, it's the planned separation of the diabetes business. That's a prime example.
Well, why so?
An empire-building management might cling to such a large revenue stream, just for scale.
True.
But Medtronic's leadership recognized the competitive landscape had shifted. Diabetes was demanding a disproportionate amount of focus and capital, and frankly, holding back more promising opportunities elsewhere in the portfolio.
So it was a strategic subtraction.
Exactly. This move is expected to actually boost the parent company's margins and earnings per share. It demonstrates a disciplined focus on maximizing long-term shareholder value, even if it means shrinking slightly in the short term. That's a tough but arguably smart strategic move.
So how robust is Medtronic's financial profile overall? Does it live up to the promise of its business model? Is it a fortress?
It's a profile of immense scale, consistency, resilience.
Yeah.
Yes. It's certainly a reliable earnings machine.
However,
always nuances, right? As we touched on, their return on invested capital, ROIC, has been consistently mediocre, hovering around 6-7% over the past 5 years.
Yeah, that number keeps coming up.
It's the primary quantitative weakness, suggesting their massive capital base again, inflated by goodwill from those big acquisitions, struggles to earn high incremental returns. But despite that ROIC, they demonstrate a truly strong ability to convert accounting profits into actual cash. That's key.
Free cash flow conversion.
Exactly. Over the past 4 fiscal years, their free cash flow, or FCF, conversion from non-GAAP net earnings has been robust, averaging over 70%.
That's pretty good.
Yeah, 73% in FY25, 75% in FY24, 65% in FY23, 80% in FY22. This high, consistent conversion is a hallmark of quality earnings. It's real cash.
And the balance sheet itself.
That's a genuine fortress. Their net debt to EBITDA ratio is conservative, around 2.2x. That provides a substantial margin of safety.
It gives them flexibility.
Exactly. Allows them to fund dividends, R&D, acquisitions without strain. Plus, their debt maturity profile is well-laddered, spread out, extending all the way to 2053. Minimizes any near-term refinancing risk.
Okay, solid foundation then. We've covered the business, its competitive edge, the leadership, the financial foundation. So what does this all boil down to for someone considering Medtronic? Is it a good value at its current price?
Right, the valuation question. Based on its current ratios, the trailing 12-month TTM price-to-earnings PE ratio is approximately 24x.
Okay.
But the forward PE looking ahead is significantly lower, around 15x to 16x.
Big difference. Why?
Likely reflecting expected earnings growth and maybe the diabetes spin-off impact.
Got it. What about cash flow?
Its price-to-free cash flow, PFCF, is approximately 21.5x. That's based on roughly a $112 billion market cap and that $5.2 billion in FY25 free cash flow we mentioned.
How does that compare historically?
When we compare this to its own history, the current TTM PE of 24x is substantially below its 5-year average of 31.5s and its 10-year average of 32.4x.
So cheaper than it has been.
Relatively, yes.
Oh.
Similarly, the price-to-sales ratio of 3.4x is well below its 5-year peak, which was over 5.0x back in 2021.
So what's your ultimate judgment here? Is this a compelling bargain, a fair price, or something else entirely?
I'd say the current price represents a fair entry point for a piece of this durable enterprise.
Fair, not great.
Exactly. It's not excessively demanding, nor is it a screaming bargain. The discount to its historical multiples seems to appropriately reflect its challenges, like its mature profile, and those mediocre returns on capital.
Okay.
You'd be paying a reasonable but not cheap price for a high-quality, predictable, and resilient stream of cash flows.
What's the primary engine for Medtronic's future growth then? Where will that come from, if it's mature?
The most important driver is undoubtedly its pipeline of innovative new products, specifically targeting large, high-growth medtech markets.
Such as?
The clearest example right now is their entry into pulsed field ablation, or PFA, for atrial fibrillation.
Explain PFA quickly.
It's a new, potentially safer and faster way to treat atrial fibrillation using electrical fields instead of heat or cold. A truly disruptive technology in a nearly $10 billion market that's growing at double-digit rates.
And Medtronic's position.
Their cardiac ablation solutions unit, powered by its Pulse Select and Afra PFA systems, grew revenue by nearly 30% in Q4 FY25 alone. It just crossed $1 billion in annual sales.
Wow, fast growth.
Yeah. Success here could significantly accelerate growth for the entire cardiovascular portfolio and, frankly, the company as a whole.
What else is in the pipeline?
Other key growth drivers to watch include the Minimed 780G system in diabetes trying to regain ground there, the Perceptor RC for deep brain stimulation in neuroscience, and the Evolute FX Plus Naviar system for heart valves. It's really about these targeted, high-impact innovations driving the next wave.
Okay, so the pipeline is key. Now, beyond just market fluctuations, what are the major long-term risks? The kind that could truly permanently damage Medtronic's earning power?
That's a critical question for any long-term investor. Thinking about what could really go wrong.
And nightmare scenarios.
First, systemic healthcare reform. A structural shift, especially in the U.S., towards maybe a single-payer system or aggressive nationwide price controls that could permanently impair their pricing power and profitability. Big structural change.
Plausible, maybe? Second,
technological obsolescence. While they're diversified, a true paradigm-shifting breakthrough could render an entire core segment obsolete.
Like what kind of thing?
Well, a low-probability but high-impact example would be, say, a pharmacological cure for type 1 diabetes, or Regenerative medicine completely replacing spinal surgery. Unlikely soon, but possible long-term.
Okay. And third.
And finally, a catastrophic cybersecurity failure. This one feels more tangible, maybe.
How so?
As devices become increasingly connected pacemakers transmitting data, insulin pumps controlled by smartphone apps, the risk of a widespread malicious cyber attack grows.
That's scary.
Significant patient harm from such an event could lead to catastrophic legal liability and an irrecoverable loss of trust. The stakes are incredibly high there.
Definitely something to keep an eye on. So, bringing it back to the market, what's the prevailing narrative for Medtronic right now? What's Wall Street saying? How is it viewed?
The market tends to view Medtronic as, well, a bit slow-growing, defensive, essentially a show-me story, meaning they need to prove they can re-accelerate growth. It's often seen as a stable but kind of unexciting behemoth that has been outmaneuvered in hot growth areas like diabetes and robotics, struggling to genuinely grow its massive asset base effectively.
And this is reflected in analyst ratings.
Yeah, you see that in the mixed buy and hold ratings. Analysts are mostly waiting for concrete evidence of a sustained turnaround before getting really bullish.
So, what's the contrarian view that our analysis might suggest? Where's the potential aha moment here for you, looking at all this?
Okay, here's where the true potential insight might lie, I think. Our analysis suggests the market may be underestimating the significant earnings power inflection point that could be created by the powerful combination of two things happening at once.
Which are?
The diabetes spin-off and the simultaneous ramp-up of these new high-margin products like PFA.
The market sees them separately.
It seems the market might be viewing these as separate incremental events rather than a combined, potentially transformative catalyst.
Explain that synergy.
Think of it as a subtraction and addition effect. The subtraction of the lower-margin, capital-intensive diabetes business should immediately boost corporate gross and operating margins. It also frees up crucial management attention and capital.
Okay, addition by subtraction.
Right. Simultaneously, the addition of new growth engines like pulsed field ablation is getting that freed up capital and focus. These are potentially higher margin, faster growing products.
So the whole becomes greater than the sum of its parts.
Potentially. The market appears anchored, perhaps, to the Medtronic of the past 5 years, a company whose growth was diluted by its struggles in diabetes. The Medtronic of the next 5 years. It could be a fundamentally more profitable and faster-growing enterprise. That's the potential narrative the market might be missing right now.
That's a truly powerful aha moment. Okay, let's bring it all together for our listener. Give us the one-pager summary, the core reasons to be optimistic, the bull case, and then the compelling counter-arguments, the bear case.
All right, the summary. The bull case, reasons to own. The bull case, reasons to own. First, durable franchise in essential markets. Medtronic's products serve non-discretionary health needs of a growing, aging global population. That creates a highly resilient, predictable, long-term revenue base.
Solid foundation.
Second, wide and defensible economic moat. Protected by those high switching costs for surgeons and hospitals, deepened by integrated services, plus that massive patent portfolio. Hard to attack. Third, rational and shareholder-focused stewardship. Management has shown disciplined, long-term thinking that diabetes separation is key evidence, and they're committed to returning over 50% of free cash flow via that multi-decade growing dividend.
Just shareholder-friendly.
And fourth, latent growth re-acceleration. It really appears to be at an inflection point where new product cycles, especially in PFA, are accelerating top-line growth. Potential to surprise the skeptical market.
Okay, that's the bull case. Now, the flip side.
The bear case. The counter-thesis. First, persistently mediocre capital returns. That ROIC of 6-7% suggests it's a good business, maybe not a wonderful one. It struggles to earn attractive returns on its enormous acquisition-heavy capital base.
The ROIC issue again?
Second, the innovator's dilemma. Its sheer size and complexity make meaningful, agile growth difficult. It leaves it vulnerable to smaller, more focused innovators nipping at its heels.
Big ships turn slowly.
Third, constrained pricing power. Despite those moats, pricing is heavily limited by powerful hospital networks and government payers. That caps long-term profitability potential.
Reality of the industry.
And fourth, execution risk. The whole bullish thesis hinges on flawless execution of multiple complex initiatives, simultaneously the Hugo robot ramp-up, PFA dominance, the diabetes separation. That's a lot to juggle perfectly.
Fair enough. Lots of moving parts. To truly understand this, let's play devil's advocate one last time. What's the most compelling argument that buying Medtronic today could actually be a long-term mistake? The ultimate value trap scenario.
Okay, the strongest counter-argument is that the company is indeed a classic value trap. And this whole idea of growth reacceleration is simply a mirage based on early, easy wins.
How would that play out?
In this inverted pessimistic scenario, the strong initial uptake of pulsed field ablation, that's just capturing the low-hanging fruit. Aggressive competitors like Boston Scientific quickly erode Medtronic's lead and, crucially, the margins.
So PFA isn't the savior?
Not in this scenario.
Yeah.
And the Hugo surgical robot? It never achieves meaningful scale against Intuitive Surgical. Instead, it becomes a costly distraction, sucking up capital and focus.
Okay.
Then, the core company, post-diabetes spinoff.
Okay.
It's stripped of its highest nominal growth unit and simply reverts to a pace where it grows only as fast as the overall economy, maybe GDP-like growth.
Stagnation, basically.
Pretty much.
Yeah.
And if that's the case, the low ROIC isn't temporary or just an accounting thing. It's a permanent structural feature of a mature bureaucratic behemoth that needs to spend billions in R&D and M&A just to tread water, just to stay relevant.
So the price isn't cheap enough.
Right. You'd be paying a fair but not cheap multiple, around 21.5x PFCF, for a business whose intrinsic value only compounds at maybe 2-3% per year. The strongest evidence for this pessimistic view: the stock's own performance. It's been stagnant for the better part of a decade, suggesting the market has long been skeptical.
So the mistake.
The mistake, therefore, would be buying into a story of renewed vigor when the underlying reality is simply one of terminal maturity. Paying for growth that doesn't really materialize. That's the value trap.
That was a truly in-depth look at Medtronic. We've explored its core business, the strength and maybe weaknesses of its competitive advantages, the leadership at the helm, and those critical financial details.
We've also really tried to unpack the market's current perception versus the potential for that significant inflection point we discussed, and also touched on the risks that could truly impair its long-term earning power.
So what stands out most to you from this deep dive? As we wrap up, maybe consider this thought for our listeners. In an industry dedicated to alleviating pain and extending life, how does that persistent pressure for short-term financial targets like those annual layoffs to make the numbers we talked about, how does that ultimately impact a company's ability to deliver the long-term breakthrough innovation that defines its very mission? It's certainly a tension worth pondering.